Good morning or good afternoon, grade 10s. This video is going to be about break-even analysis, and it's going to fit perfectly with our business project, the Dragon's Nest, that we're working on. First of all, what is a break-even analysis? Well, it's an analysis that determines at which sales volume your firm or business will start making money. So in English, what this means is how many units will you have to sell in order to start to make a profit? And just a reminder here, the term revenue we talked about in the course already, it equals your sales. It has nothing to do with your profit yet. Revenue basically is your price times the number of units you sold. So if you're selling t-shirts and you're selling them for $20 and you sell 3 t-shirts, your revenue is $60. Okay, so there's a formula for the break-even analysis. The formula is fixed costs divided by your revenue minus variable costs. So let's talk a little bit about what fixed costs are and variable costs. And this is going to take us into our accounting unit a little bit. So first of all, fixed costs. These are costs that must be paid whether or not any units are purchased at all. This is like your hydro, your telephone bill, salaries of your employees. And these costs are fixed only over a specified period of time. So for the year, let's say. So some of you might be buying business cards. Those would be fixed costs because those costs have nothing to do with the number of t-shirts or anything you're going to be selling. And then variable costs, these are the costs that vary directly with the number of products that are purchased. Okay? So sometimes labor is used in this for example, if you're paying people specifically to manufacture a product, things like that. So in our case, in our classroom, some of you are going to be making gift baskets, some of you are selling t-shirts, socks, some of you are selling other things. Your variable costs are going to be the costs you have incurred to make your gift basket or to make your t-shirts, things like that. So everything that goes in each individual unit. So how much does it cost you to make one of whatever it is you're selling? Some of you are baking treats or baking other things. How much does it cost for you to make one muffin or one cookie, or you could sell it by the batch, things like that. Okay, so we know our formula. Here's a high-level example. So example 1 is a company has total fixed costs of $50,000 per year. So this is all their hydro, their lighting, their salaries of their office employees, things like that. And they typically sell between 10,000 and 30,000 units of their product per year. So let's assume their variable cost. So this is how much it costs to make 1 unit of their product. So $1.60 goes in of materials for each unit, and $3 goes into labor. So one person might, let's say they're making slippers, and they use $1.60 worth of materials, and the $3 is what you pay them to make 1 unit. Maybe they're knitting them. So in total, for each pair of slippers, it costs you $4.60. So if they sell each one of those pairs of slippers for $9 per unit, this is how we're going to put it into our formula. So remember fixed costs, which is $50,000, and our revenue, which is our selling price per unit. So it's $9 to sell our slippers, and it was $4 it cost us to make each pair of slippers. So $9 minus $4 is $4.40, and we divide 50,000 by that $4.40. And therefore you come up with 11,363.64 units. That's how much, I'm going to actually add the S onto there, that's how much many units it's going to cost before your company is going to start making a profit because of that $50,000. Let's look at a different example. So let's say we're in our businesses, in our classroom, we're selling mugs, and we're going to put personalized photos on it. Do you like the name of the company? Mug with Photo on It Company. Not very creative. Anyway, so let's say this is a small group in our class, and they bought business cards and posters, and their costs for that stuff was $200. Those were their only fixed costs, because we're having small businesses in our classroom. Let's say it cost them $5 to buy each mug. And to add a photo, they're going to go to Walmart and use their fancy Photoshop there and bring a USB with a photo on it with a personalized picture of their family. It's going to cost them $2 to do that. So in total, it's going to cost $7 to make each mug. So here's where the revenue comes in. Remember, revenue is your sales. So if you're selling each mug for $9.50, let's put all of these variables into our break-even analysis. So our fixed cost was $200. We're going to divide it by our revenue minus our variable costs. So $9.50 minus 7. You're going to do that first because remember bed mass. You do brackets first. And then you're going to go 200 divided by that. And you're going to get 80. So this company is going to need to sell 80 mugs to break even. So what I want you guys to do is a break-even analysis for your companies to see how many of your products you're going to need to sell in order to break even. This could be a big eye-opener for some of you. Some of you are keeping your fixed cost very low, so that's a good idea. Good strategy. Some applications for the break-even analysis would be to determine how changes in your price and sales level, so volume, or cost increases or decreases are going to affect your profitability. So if you're not happy with this 80 mugs that you need to sell, you could increase your price. So the more you increase your price, the fewer units you would have to sell. However, if you get your costs down as well, the fewer units you would have to sell to break even. So companies use the break-even analysis very often when they're starting up so that they can get a good handle on how many they're going to need to sell of their product in order to be profitable.